Hello, investors. Welcome to the channel where I use technical analysis to find possible swing trades. Today, we're taking a look at Medical Properties Trust, ticker symbol MPW. This is a small cap REIT with a market cap just under $5 billion. And as you can probably see in the name, it is a REIT, meaning they own and operate properties for other businesses to use and make profit from those properties in the form of rents or leases. And again, from the name, you may be able to determine that a medical properties trust focuses on medical buildings, hospitals, and other medical facilities as a primary source of income. And here we have the annual chart for MPW. You'll see it has dropped recently after an earnings call, and it is well below all the moving averages. There looks like there's a point of support a bit below where the share price is at the moment. I'll put it on line here, probably around the $7.15, $7.25 range. So this could fall a bit more and still find support at a lower valuation. The RSI has dipped into oversold territory, and both stochastics are well into oversold. The one appears to have started to turn back, but I wouldn't put any stock in that at the moment. The shares do still seem to be falling. And we have the volume chart, which shows a corresponding spike in selling pressure. And that selling pressure does not appear to be waning at the moment. The MACD is falling, pretty sharply falling too. It's well below zero and does not appear to have formed a trough yet. So this company, from a technical standpoint, does look like it is bouncing lower and has not yet found the bottom. So it seems like this is a good time to either start dollar cost averaging in or to have it on your watch list for the near future so that you can be ready if you see it form a bottom and the technicals show that it's starting to go higher again. And if we switch over to E-Trade to take a look at the fundamentals, and one thing I'll mention quickly here is that there was a problem with the company where they divested themselves of several hospitals and it affected their overall cash flow. But that process is over and the company appears to be moving forward with it. And if you want more information on that, then it is certainly available online. But for time constraints, I can't spend the time to go into it. But it does look like there is a significant short interest in this at almost 21%. And that is certainly ripe for a short squeeze. Not sure if a short squeeze will happen. Of course, I don't have a crystal ball, but if you own shares and they suddenly skyrocketed, then you could absolutely take advantage of that. In any case, looking at the debt, it shows that MPW has average debt for a REIT, and we know REITs typically carry quite a bit of debt, so those numbers are not insignificant. The PE ratio is high. The PE is just about 70, and that is extremely high, and that's more a function of the earnings than the share price. And again, this has to do with the recent divestiture of other properties affecting their income. So we will see how the PE and the final share price stabilize over time moving forward. Now, the gross margin here for profitability is outstanding, beats out 98% of other companies in the REIT industry, which is saying something. And even the operating margin of 17% is excellent, beats out 63%. But you know that the all-important metric for REITs is cash flow. And if you look over here, the cash flow of 3.77 it's not compared, but that is decent for REITs just based on others I've looked at. And the net profit margin of just over 5% is fair as well. The return on equity is also average, and the growth rate is less than 74% of other companies in the REIT industry. And again, that's due to the fact that they actually lost facilities over the last year rather than gaining them. Now, the dividend we have here is listed as over 14%, which is outrageously high and is certainly suspicious. In other platforms, I've seen it listed as just over 11%. So this is a variance based on how they calculate the dividend, but it is high. It is undeniably high. It's certainly well above what other companies pay out, and it shows here that it beats out 98% of other companies in the REIT industry, which is an industry known for paying out high dividends. So the question then becomes, how secure is that dividend? And if you look here, the payout ratio of almost 10 times their income, which is absolutely unsustainable. Now, I'm used to seeing REITs with a very high payout ratio. They use accounting tricks and magic behind the scenes to have payout ratios that are greater than 100%. But this payout ratio is higher than any that I can remember seeing. This is a red flag, although, again, there's a lot in flux with this company over the last year. So it does seem likely that the payout ratio is actually not 10x the company's earnings. And again, if we revert back here to the debt to equity, that's average debt. The only way they could pay out 10 times their earnings in dividends is if they were going deeply into debt. So this is some sort of accounting shell game where things are being shuffled around, and this is simply how the numbers work out when they're required to post them. But in any case, with the share price being this low, this looks like a fair opportunity to at least put it on your watch list and consider taking a position in the near future. But let me know what you think in the comments below. And please remember that none of this is financial advice, because I'm not a financial advisor. And if you got something out of the video, I would appreciate it if you'd hit the like button and subscribe to help out the channel. If you enjoy this kind of content, please hit the bell notification to be alerted when new videos are posted. Also, if you'd like me to take a look at a particular company using the indicators I present here, just mention that in the comments and I'll try to get to it as soon as I can. That's all for today. Thanks for watching, and good luck with all your investments.